We are now going to start off with this question, which is a AAA Practice Exam 1 question. Question number 1 of the AAA Practice Exam 1. The name of this question is Eagle Group. Now, this is again one of the question number 1 of the AAA. What I will do is that I will go through this question, I will go through the requirements of this question, and then we will start discussing each one of them one by one. It says it is 1st of July 2005. You are a manager in the audit department of Bison & Co., a firm of chartered certified accountants responsible for the audit of Eagle Group, the group, which is a financial year ending on 31st August 2005. So we are being told that the financial year end of Eagle Group is 31st August 2005. Your firm is appointed to audit the parent company. Your firm is appointed to audit the parent company, Eagle Company and all of its subsidiaries, with the exception of Lynx Company, a newly acquired subsidiary located in a foreign country which is audited by a local firm of auditor, Vulture Associates. So you are required to audit all of the components except for one of the foreign subsidiary which you are not going to be auditing. It says all the companies in the group report using IFRS as the applicable financial reporting framework and at the same financial year end. So all of the companies in the group report using IFRS as the applicable financial reporting framework and have the same financial year end. The following exhibits available on the left hand side of the screen provide relevant information to the question. So this is the information that is being available. The following exhibits provide the information: partner's email, an email which you have received from Maya Craig, the audit engagement partner. The background information, which is the information about the group, including a request from Group Finance Director in respect of non-audit engagement. The group's financial statement SOFP extract for the projections to 31st August 2005 with comparatives and accompanying explanatory notes. And the group financial statement extracts from the group statement of profit or loss projected with comparatives and accompanying explanatory notes. Goodwill, the management's determination of the goodwill arising on acquisition of Linux Company, the component auditor, etc., etc. Now what exactly is the requirement? Let's just talk, let's discuss. In the requirement it says respond to the instructions in the email from the audit engagement partner. What do you have to do? You have to respond to the instructions in the email from the audit engagement partner. What is the partner's email? Let's talk, let's discuss. It says to the audit manager from Maya Craig, the audit engagement partner, subject audit planning of the Eagle Group, audit planning for the Eagle Group. It says I held a meeting yesterday with the group finance director and representatives from the group audit committee. I held a meeting yesterday with the group finance director and representatives from the group audit committee, and we discussed the number of issues which will impact on the audit planning, Using the information provided, I require you to prepare briefing notes for my use in which you evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures to assist in identifying audit risk. So again, it's one of those questions which require you to use the analytical procedures also to identify the audit risk. Then it says you are not required to consider audit risk relating to disclosure, as these will be planned for later in the audit process. Okay, so we got to ignore the disclosures. Design the principal audit procedures to be used in the audit of goodwill arising on the acquisition of Linux Company. Management's calculation of the goodwill is shown in exhibit number 5. You do not need to consider the procedure relating to impairment testing and so on, so on, so. Lastly, it says using the information provided in exhibit says evaluate extract of the audit strategy prepared by Vulture in respect of their audit of Linux and discuss any implications on the group audit. And lastly, after considering the request in exhibit 2 from group finance director in respect of our firm providing advice on group's integrated report, discuss the ethical and the professional implication of this request, recommending any further actions which should be taken by our firm. Now, if I talk about the requirement, so this is one of the requirement. Let's talk about the background information about this company. I repeat, let's talk about the background information about this company. It says the group, which is a listed entity, operates in distribution, supply chain and logistics management. Its operations are worldwide. Spanning more than 200 countries. Okay, so they are operating in more than 200 countries. So one of the risks that could possibly arise is that two, the audit engagement partner from the audit manager, the subject is briefing notes in respect of the audit of Eagle Group. I have prepared the briefing notes for your use and following are covered in these briefing notes. Okay, I would rather write it down like this. Evaluate the audit risk to be considered, or you could say evaluation of the audit risk to be considered in planning the group audit. Now, the questions requirement is like that we have to use the analytical procedure. So what I will do for my own purposes is that I would rather use these financial statements to actually perform the analytical procedures. These are the consolidated financial statement, balance sheet is given. Now, so what have we done? We have actually copied this P&L, we have copied this balance sheet in here. We have performed the analytical procedures using them. Let's just see what is available. We have got the balance sheet. Okay, we've got the balance sheet available to us. Goodwill, other intangible assets, property, plant, equipment, other investments. We have got the total non-current assets here, then we have got the current assets. Then we have got the current assets. Now it says the equity and liabilities, share capital, retained earning, other components of equity, the non-controlling interest, non-current liability, etc., etc. Now, revenue which is projected. So the revenue is expected to decrease. There is this other operating income which is expected to increase. The operating expenses 55405800. Okay. So the operating expenses are expected to reduce. I am removing this negative sign because at times what happens is that okay, so it has actually given us this thing, revenue has decreased by 3.7% per year due to new competitor in the market taking over. Reversal of provision, the reversal of impairment loss on receivable, foreign current gains, profit or loss on disposal of non-current assets. So this is something that is being provided to us. Now, the operating expenses includes the following items, which is 2005, 2004, the staff cost, the cost of raw materials, at the same time depreciation, amortization, etc., etc. All of this is available. So what are we going to do? We're going to try and calculate some of the ratios. So if I try to calculate the change in revenue, change in COGS, change in GP, GP margin, operating profit margin, then what happens is that you are not being provided these details of the current assets. Okay, you could calculate the current ratio, you could calculate the interest cover ratio, you could calculate the gearing ratio. All of these could be done. Now let's discuss about it. So basically the revenue is going to be, the change in revenue is going to be calculated like this. Well, it has already been calculated by the examiner, but again, then change in cost of sale, change in GP. The GP margin is, in fact we don't have any GP, so there is no you could rather say change in operating income, change in operating expenses. Now operating profit margin is what? This divided by this. The current ratio is current assets divided by current liabilities. The interest cover is what? Operating profit divided by finance cost. The gearing ratio is what? Non-current liability divided by total equity and liabilities. In fact, equals to non-current liabilities divided by total equity plus total non-current liability. So basically what happens is, so this is what you have got. Now, what we need to do is that we need to actually identify more things. I mean, with respect to this analytical procedures, I have actually performed few of the procedures which I could perform in the given scenario. Now I'll be talking about more things. From these analytical procedures, what we are able to see is that revenue has declined, the operating expenses have declined, so the operating profit margin has gone up. The current ratio has decreased, the interest cover has increased, the gearing has decreased slightly. Now, we would actually go through further in these financial statements and see what is actually going on, because ultimately we have to identify the risk. Now see, what does it say? Okay, it says the goodwill relates to the group's subsidiaries and is tested for impairment on an annual basis. So that means there is no risk. Management will conduct the annual impairment review in August 2005, but it is anticipated that no impairment will need to be recognized this year due to the anticipated growth in revenue which is forecast for the next 2 years. In November 4, the group acquired an 80% controlling holding in Link Company, a listed company located in foreign country for a consideration of $351 million. Management determination of the goodwill arising on this acquisition is shown in exhibit number 5. So what could possibly happen is that if I could just try to identify a few of the things. So with respect to the goodwill in foreign subsidiary could be one of the areas of the risk which we will be discussing. Now what next is there? The next situation is other intangible assets. With respect to other intangible assets, it says relates mostly to software and other technological development cost. Other intangible assets relates mostly to software and technological development cost. During the year, $35 million was spent on developing a new IT system for dealing with customer inquiries and processing orders. A further $20 million was spent on research and development into robots being used in warehouse, $5 million on developing new accounting software. These costs have been capitalized as intangible and are all being amortized over a 15-year life. So what actually happens is that when you are going to be talking about it, so the intangible, what you could do is that you could say that with respect to this intangible, I repeat, with respect to this intangible, what you could do is that you could say that the research and development have taken place. All the expenditure has been capitalized, there is a risk that research related costs are capitalized. There is a risk that the research related costs are capitalized and that the development expenditure do not meet the criteria for capitalization. Okay, what we would be doing is that we would be discussing all this over time, that what exactly is it, but right now I'm just trying to figure out the things. A share issue raised cash of 100 million which was used to fund the capital expenditure. So the share issue, which is the accounting for the share issue. Now what next is there? Non-current liabilities. It says non-current liability include borrowing of 550 million. In the previous year it was 500 million. So 50 million has been obtained right now. And provisions of 100 million, it was 120 million last year. Changes in financing during the year have impacted the group WACC. Information from the group's treasury team suggests that the weighted average cost of capital is currently 10%. So the non-current liabilities include borrowing and so and so. So what could possibly happen is that the classification of with respect to the non-current liability, there could actually be understatement of provision. There could also be further the errors in classification of liability. So that could also be something that can happen. Now what next is there? So with respect to the SOFP, I'll be talking a lot about these risks, but first of all let me just identify through the scenarios. Now we have got the group P&L available here. We have got the group P&L which is available here. The extracts from the financials are given. We know there is a gain on investment property revaluation. So this is probably incorrectly accounted for. Accounting for investment property revaluation. The gain in investment property revaluation is not correctly recorded. It should have been recorded in P&L rather than in OCI. So it should have been recorded in P&L rather than in OCI. Revenue has decreased due to competition. Okay. What about the current assets? It was 1420, now it's 1450. So maybe with respect to the current assets, you could say that maybe the current assets will be overvalued as revenue has declined. And the increase in the current assets could be attributed to the inventory. Now what next is there? The next situation is, we have got the next situation that we have got is, it says that other operating income comprises the following item. Other operating income comprises the following item. What is that? The provisions for reversal of the provisions is there. So there could actually be operating income. The provision could have been wrongly reversed. The provision could have been wrongly reversed. So what could possibly happen is that the provision could be wrongly reversed. Now what next is there? The next situation is, you have got few more things which are mentioned in P&L. Reversal of impairment losses on receivable and other assets. So receivable and other assets, there is a reversal of impairment. So we need to check what has actually happened. Now foreign current gains, profit or loss on disposal of non-current assets. Okay. So these are also, the exchange differences are also arising. So what could happen is that the risk that reversal of foreign gains are not appropriately calculated. Risk that foreign gains are not appropriately calculated. Now what next is there? The next situation is, it says that reversal of impairment losses on receivable and other assets. So risk that reversal was not appropriately determined on the risk that the reversal was not appropriately determined on the receivable and other assets. I am just compiling the points. I will write them down into a proper answer. So you have got staff cost, which is 3650 now. The cost of raw material is reducing. Depreciation has increased. Other operating expenses have decreased. Now, risk of understatement of other operating expenses. Risk of understatement of the cost of raw materials. So that is all something that could happen here. I bet that is all something that is going to happen over here. Now, what has actually happened is that I have just summarized the information from what was available to me, but I have not gone through the background information as yet. I have not even gone through this component auditor area yet. So let's talk about it. Now it says group operational activities. The group, which is a listed entity, operates in distribution, supply chain and logistics management. Its operations are worldwide, spanning in more than 200 countries. So what could actually happen is that if the operations are in more than 200 countries, this could lead to the control risk. Because when you have to manage a larger or diversified operations, the control activities, the control risk could arise. Next is that the group's strategy is to strengthen its market share and grow revenue in sustainable manner by expansion into emerging markets. There are 50 subsidiaries in the group, many of which are international. So there are over 50 subsidiaries in the group. More than 50 subsidiaries with majority in international markets gave rise to a risk in the measurement of foreign currency transactions. Now what next is there? It says there are three main business divisions: post and parcel delivery, commercial freight and supply chain management, each of which historically has provided approximately 1/3 of group's revenue. So you've got three different segments, and each of the segment has provided you each of these segment has provided you a sort of 1/3 of the group's revenue up till now. Now what next is there? It says a fourth business division which focuses purely on providing distribution channels for the oil and coal sector was established 2 years ago, and in 2005 began to grow quite rapidly. It is forecast to provide 12% of the group's revenue this year, growing to 15% in 2016. This division is performing particularly well in developing economies. Now see, your overall revenue is declining. There is one segment whose revenue is increasing. So that means the revenue of the other segments is decreasing. That's an indication of impairment. The revenue decline of the three segments is an indication of impairment. There is a risk that the assets are not tested for impairment. There is a risk that the assets are not tested for the impairment. Now what next is there? The next situation is it says the division is performing particularly well in developing economies. Okay, so that's about one division. What about the rest? Now, it says in recent years revenue has grown steadily, based mainly on growth in some locations where e-commerce is rapidly developing. This year revenue is projected to decline slightly, which the group attributes to increased competition as a new distribution company has taken some of the group's market share in a number of countries. However, group's management is confident that this is a short-term drop in revenue and forecast return to growth in 2006. So obviously that is a reflector of impairment, that your revenue has actually declined. Now what next is there? Let's discuss about it. The next situation is, it says, the group has invested in automating its warehousing facilities, and while it still employs more than 250,000 staff. The group has invested in automating its warehousing facilities, and while it still employs more than 250,000 staff, many manual warehouse jobs are now performed by robots. Approximately 5,000 staff were made redundant early this year due to automation of their work. Other innovations include increased use of automated loading and unloading of vehicles, and improvements in the tech used to monitor and manage inventory levels. Now, this is actually a situation which is giving rise to the restructuring provision. So with respect to the restructuring for the staff redundancies, a provision for restructuring is required, and risk is that such provision has not been recognized as yet. Now for the integrated reporting, it says, the group is proud of this innovation and is keen to highlight these technological developments in its integrated report. The group finance director has been asked to lead a project tasked with producing the group's first integrated report. Finance director sent the following request to engagement partners, so and so, so and so. Now see. Okay, so for the first requirement, that was that you have to evaluate the audit risk to be considered in planning the group audit. You should use analytical procedures to assist in identifying the audit risk. You are not required to consider audit risks relating to disclosures, as these will be planned for later in the audit process. So what is it that you need to do? Evaluate the audit risk to be considered in planning the group audit. You should use analytical to assist in identifying audit risks. Now, if I could just go back to the audit risk. So I'll just list down few of the risks so that you people do have an idea that what exactly are these things. There is one or two of the risks that I will draft, the rest of them I will just list down. So if I could just draft this specific area, I would say that Eagle Group's operations are based in more than 200 countries. Eagle Group's operations are based in more than 200 countries. Eagle Group's operations are based in more than 200 countries. In order to in order to manage and record such a wide area of operations, there a strong system of internal controls is needed. There is a risk that there may be weak controls within the organization, resulting in misstatement of financial information. The second one of them is accounting for foreign subsidiaries. More than 50 subsidiaries of Eagle Group are based outside their home country and are likely to be operating with foreign currencies. There is a risk that the translation of financial statements and the establishment of the exchange gains/losses on these subsidiaries are not done properly, as it is a complex area of accounting. So, do you people get it? Yeah, do you people get it? Yeah, is everyone okay with this? Okay, now okay, now the next one of them is I am just now gonna write down the points. I'm not going to be drafting the whole of it, because you now have an idea, especially from the previous sessions also, that how to actually draft. All that I would be doing is that I would now be listing down these things. So I would say that the revenue has declined for all the three segments. This is an indicator of impairment. The revenue has declined for all the three segments. This is an indicator of impairment. This is an indicator of impairment. There is a risk that assets are not tested for impairment, resulting in overstatement of assets. Staff has been made redundant. And further redundancies are planned for the future. There is a risk that restructuring provision is not appropriately provided for. Okay, there is something about the goodwill that we did not go through. There was this cash consideration paid, then there was this contingent consideration paid. The total consideration is there, the fair value of NCI is there, less fair value of identifiable assets is there. So it says the contingent consideration will be payable 4 years after acquisition date and is calculated based upon a payment of 525, only payable if Linux reaches revenue and profit targets. Amount included has been discounted to present value using a discount factor based on an 18% rate. So what is actually going to happen is that you would say that with respect to the goodwill calculation, in the foreign subsidiary, you would say that the contingent consideration has not been discounted using appropriate rate. A rate of 10% was required to be used, which is the reflection of the weighted average cost of capital of the entity. So that is something that has to be done. Further, let's talk further about the goodwill. Now what next is there? It says the non-controlling interest is measured at fair value, the amount being based on Linux company's share price on 1st November 4. Okay. Then it says the assets and liabilities. When did you acquire? 1st November 4. Assets and liabilities and their fair values were determined by an independent firm of chartered certified accountants who was engaged to perform due diligence on Linux prior to the acquisition taking place. A fair value of uplift of 12 million was made in relation to property, plant, equipment. Now, what we actually need to do is that we need to say that the valuation used for fair value of net asset is the one which has been performed by the firm which did the valuation which did the valuation, which performed the due diligence exercise. Which performed the due diligence exercise. Now, there is a risk that such valuation is not appropriate and the appropriate valuation is required to be used. Is not appropriate. Further, the foreign currency goodwill should have been translated using closing exchange rate and the exchange gain/loss was required to be calculated. Such gain/loss has not been established. Then what next is there? With respect to intangible, research and development have taken place. All expenditure has been capitalized. There is a risk that it is not meeting the criteria. Accounting for the share issue may be incorrect as the accounting for the share issue may be incorrect as the share issuance is to be recorded in the share capital and share premium accounts. The provision is likely to be understated or is reclassified into the current liabilities. Considering the technological advancements taking place, the provision for considering the technological advancements taking place, the provision for non-current, the provision for redundancies should have increased. Now what next is there? Investment property, if carried under the fair value model, is remeasured to fair value at each reporting date, and the gain or loss should have been recognized in P&L rather than in OCI. Since the revenue has declined, therefore, this is indicating that inventory is slow moving. There is a risk that inventory is not recorded at the lower of cost or NRV. For the operating income, so these are further risks that are arising. Now, what I have done is I have not drafted a detailed answer on all of them. I just drafted 2 points so that you could have an idea. but it's just that I'm listing down the issues. I'm listing down the issues for you people. So that is actually the first requirement of the question, which was about the evaluation of the audit risk to be considered in planning the group audit. Next is that design the principal audit procedures to be used in the audit of the goodwill arising on acquisition of Linux company. Management's calculation of the goodwill shown in Exhibit 5. You do not need to consider the procedure relating to impairment testing or to foreign currency retranslation, as these will be planned later in the audit. Okay. So you don't need to consider them. This is part B. Now what next is going on? Let's try to see this thing. Basically, what you would do is that you would say this thing, that with respect to the goodwill calculation, the various procedures that need to be inspect the share purchase agreement to confirm the terms of acquisition, trace payment made in cash to bank statement to confirm that payment has been made. The third one of them is recalculate the fair value of non-controlling interest to confirm its accuracy. Now what next is there? Inspect the report on the fair value of net assets published and confirm that fair value is traceable to the due diligence report. Then what next is there? You perform this. Okay, now see. Recalculate the present value of the contingent consideration to confirm that a correct figure is included in goodwill calculations. So you have performed on cash consideration, that share purchase agreement, the bank statement. For the contingent consideration, the recalculation, etc. For fair value of NCI, again recalculation. For the fair value of identifiable net assets, you need to inspect the fair valuation report. Now there is also something that you could do. What is that? Let's try to understand this. You would test the assumptions used by the ACCA firm for the establishment of fair value of net assets for reasonableness. So that is something that you got to do. So Abid, that is something that you got to do. So another requirement for the question was that you had to design the principal audit procedures, and what we did was we did design the principal audit procedures to perform the calculation. Now the next situation is, using the information provided in Exhibit 6, evaluate the extract of the audit strategy prepared by Vulture Associates in respect of their audit of Linux company. So, using the information provided in Exhibit number 6, evaluate the extract of the audit strategy prepared by Vulture Associates in respect of their audit of Linux company. 2 points below are extracted from the audit strategy. Other sections of the audit strategy, including the audit risk assessments, have been reviewed by the group audit team and are considered to be satisfactory. Linux is projected to make a loss this year, and the group audit team is confident that sufficient procedures on going concern have been planned for. We'll place reliance on internal controls, which will reduce the amount of substantive testing which needs to be performed. This is justified on the ground that in the previous years audit controls were tested and found to be highly effective. We do not plan to retest the controls, as according to management there have been no changes in the control environment during the year. Next, with respect to internal audit, it says Linux has offered the services of its internal audit team to help perform audit procedures. Linux has offered the services of its internal audit team to help perform audit procedures. We are planning to use the internal auditors to complete the audit work in respect of trade receivable. We are planning to use the internal auditors to complete the audit work in respect of trade receivables, as they have performed work on this area during the year. It will be efficient for them to perform and conclude on the relevant audit procedures so and so. Now let's talk about few things that are actually being mentioned. What are we required to do? We are required to evaluate the extract of the audit strategy prepared by Vulture Associates in respect of their audit of Linux and discuss any implications for the group audit. Now, what does it say? It says control effectiveness will place reliance on internal controls, which will reduce the amount of substantive testing which needs to be performed. Okay. First of all, the substantive testing can only be reduced if the internal controls are assessed to be effective and sufficient. The auditor is required to update its understanding of the internal controls on a regular basis also considering the changes in the circumstances that take place with time. Purely relying on the work performed in previous year as the situation, circumstances change over time and they have an impact on the control environment. So the auditor should plan to perform an assessment of the system of internal controls that is one thing that you got to do. Now next situation is with respect to the internal audit department. It says Linux has offered the services of its internal audit team to help perform audit procedures. We are planning to use the internal auditors to complete the audit work in respect of trade receivables. As they perform work on this area during the year, it will be efficient for them to perform and conclude on the relevant audit procedures, including the trade receivable circularization and evaluation of the allowance for receivable, which we will instruct them to carry out. Now see, what happens is that the external auditor can use the work of internal auditor, and the internal auditor can also be required to perform work under the instructions of the external auditor if allowed by those charged with governance. Now what next is there? The next situation that actually happens is that the reliance on the work of internal auditor can only be placed if the internal auditor is operating independently, is qualified, competent, and his line of responsibility or his line of reporting is independent to the board and not to the finance department. So, without considering certain factors, the auditor cannot place reliance on the work of internal auditor. Now I would say based on above what? Based on above, the reliance on the work of external of the component auditor cannot be easily made as the component auditors planning has lackings, and these lackings are to be overcome. By the Eagle Group's auditor planning procedures on the work performed by the Linux company's auditors. So that is something that you would have to do. I repeat, that is something that you would have to do. Now, is everyone okay till part C? Yeah, is everyone okay till part C? Any issues, any questions till part C, please? Yeah, the revenue decline would be an indication of impairment because the utilization of the assets would have reduced. Okay, I'm just slowing down a bit. You may check. Let me know in case if there is any issues with respect to it. Yeah, I'm slowing down a bit. Let me know if there is any issues. Yeah, let me know in case if there are any issues. Okay, we have got the final requirement which is available. And what is that final requirement? Let's just see this. It is that after considering the request in exhibit number 2 from Group Finance Director in respect of our firm providing advice on the group's integrated report, discuss the ethical and the professional implications of this request, recommending any further action which should be taken. So let's talk about this integrated report. It says the group is proud of this innovation and is keen to highlight these technological developments in its integrated report. The group's finance director has been asked to lead a project tasked with producing the first integrated report. The finance director has sent the following request to the audit engagement partner. Now see, what happens is that the preparation of integrated report is at times within the scope of audit and at times not within the scope of audit. Jurisdictions where auditor has a responsibility to report on the integrated report. In such case, jurisdictions where the auditor has a responsibility to report on the integrated report, in such case, preparing integrated report would lead to a self-review threat. However, where it is not mandatory for entity to prepare and for auditor to report, the integrated report would be treated as other information and the auditor would have the responsibility to read the other information accompanying financial statements, in case if there are any differences in the auditor's understanding and the report, then auditor is required to communicate with management and those charged with governance. In case if the amendment is not made, so in case if they don't make the amendment, then auditor shall mention about the report in which inconsistency is found in the other information and under the other information section of the audit report. Now what next is there is this final thing and then this question is going to be concluded. This is something that I have told you with respect to the requirement of ISA 710. We would like your firm to assist us in developing our integrated report. It's a management role, and to provide assurance on it. Assurance and preparation will lead to self-review threat. As you believe this will enhance the credibility of the information it contains, specifically we would like your input into the choice of KPI which should be presented, how to present them and how they should be reconciled where relevant to financial information from the audited financial statement. Now, in case if auditor is allowed by law, they can engage in preparation of integrated report, but in that case they will not be allowed to provide assurance on this report. Publication of integrated report is not a requirement in the jurisdiction in which the group is headquartered, but there is a growing pressure from stakeholders of the integrated report to be produced by listed reporting entities. If Besson & Co. accepts engagement in relation to a group integrated report, the work would be performed by teams separate from the audit team. The safeguard adopted of deploying a separate team is appropriate. So anyways, this is something that you would be writing with respect to it. This is the only screen that I can show you. I can share the answer with you people, but this is the only screen I can show you right now. I've got limitation because of this, because of the way this practice platform is. So we are done with this question, the name of which is Eagle Group, and it is one of the past examination questions of the AAA paper.